So let's continue on with this rather lengthy merger and acquisition reading. So again, there's lots of information here. We've sort of gotten through a lot of the soft issues. Maybe the bootstrapping stuff was a little more tangible, but we have the actual valuation part ahead of us here. So as we look at this, when it says, valuing a target company, your job is to, compare and contrast and maybe utilize three different methods here: DCF, comparable company, comparable transaction. I hope when you look at this, you say, oh, this is the same song we've been singing, right? So there's absolutely nothing new here except for maybe the idea of a takeover premium. So this is, if you've already gone through the equity material, all that, there's nothing new going on. It's just we're taking our standard plays, which are, discount the cash flows, do relative valuation. Maybe later we'll see, in some areas we'll see capitalized income, not here. But there's very few ways that we approach this, and we're just applying them here to the target firm. So don't treat this like it is something, oh, I've got to learn discounted cash flow analysis or comparable company analysis. You already know this. All we're doing is talking about a few specifics in association with mergers and acquisitions, all right? Okay, so first of all, DCF, discounted cash flow method. So determine the free cash flow. I would say calculate the free cash flow might be another way to view that. So calculate the free cash flow and then discount it back to today, just like we would with any other equity security, piece of real estate, whatever it happens to be. So we're probably going to be using something like a free cash flow to the firm in this case, and we'll look at that calculation in a little more detail in just a moment, but like I say, we've already seen it. Okay, the other option, that would be these two options together, or the other option, is to do relative valuation. So we can think of this as something like a PE ratio, all right? So we're going to take a PE ratio, and of course, you take a PE, you multiply it by E, right? Okay, and the E's cancel, and we get the price, right? So what we're going to be doing is doing relative valuation. Price to earnings, price to book, price to sales, those types of things, price to cash flow. So, and we're just doing that and we're applying it to a takeover or a target company. But one distinction here is we have to decide what are our comparables. So when we talk about a comparable company, okay, a comparable company means we're just using an old, some company out there. We're looking in the newspaper to get the price that we're then dividing by earnings. When we talk about a comparable transaction, we're talking about a firm that has actually transacted. That is, the firm itself has been sold. So when we talk about comparable company, we're using minority prices. When we talk about comparable transaction, we're using an acquisition price. So the difference is this. Okay, if we're going to do this number 2 here, that is, we're going to use a comparable company. If we say, look, the PE ratio that we think is appropriate is equal to 10, and the earnings of our firm are going to be 10, earnings of our firm are going to be $1. Then we're going to take 10, multiply it by $1, and we're going to say, okay, the price is $10 a share. But that's based on minority purchases, right? So if we're going to say, look, as buying a minority price, this would be worth $10 a share. Control has value, so we're going to have to apply a takeover premium, right? So we're going to start with a minority price and then add a premium here. And down here, we don't have to do that, right? Why do we not have to do it? Because the premium is already built into the comparable. So we looked at the price, divided it by earnings, but the price was the deal price. All right? So anyway, so these last 2 and 3 are the same thing. It's just, are the comparables, are they minority prices? If they are, we have to add a takeover premium. If they're deal prices or takeover prices, then the premium is already embedded and we don't have to worry about it. All right? So DCF, okay, calculate the free cash flows, get you a model, discount it back. Or price to earnings, price to sales, price to cash flow, all that sort of stuff. You've seen it all before. There's nothing new here. Okay, so this slide for discounted cash flow, I would say this is a big DNM, right? Do not memorize this slide. Step 1, 2, 3, 4, 5, 6. All this says is, hey, apply the, remember all that discounted cash flow stuff we did previously and in 5 other places in the curriculum? Let's do it here too, right? So which model do we want to use? We're going to use, just a direct capitalization approach. We're going to use a 2-stage, a 3-stage, We could use an H model or, whatever it is, but we got to come up with a model here. So we're going to estimate some cash flows for a few years, and then we're going to come up with a terminal value, probably using the Gordon growth model, just like we do in every other situation. Okay, then once we know what model we're going to use, we're going to have to do some forecasting to get the free cash flows. So forecast the financials, get the free cash flows, discount the free cash flows back, okay, and then come up with a terminal value via the Gordon growth, and then add all that together in present value. You know this, all right? So there's nothing here that's new. You've been doing it since grade school. Well, maybe not grade school, but certainly since level 1, right? So if we want to calculate free cash flow, here is a way to calculate the free cash flows, right? So we start with net income. We could add back the net interest after tax. That would give us an unlevered net income. Then we could look at the change in deferred taxes. So if deferred taxes went up, that means we didn't actually pay that in cash, so we would end up adding that back. Then that would give us a net operating profit less adjusted taxes, or NOPLAT. Then add back non-cash charges, account for the change in working capital and capital expenditures, and that would give us free cash flow. Okay, I think this is also a D&M. Okay. And the reason is, we already know this. I mean, we don't specify it in exactly these terms, but going to the next slide, this is the formula for free cash flows that you've been seeing since level 1. It's going to get you to the same place, right? So, and you already know it. You already have it on your formula sheet. So all this says is, look, we're going to go and we're going to say, we're going to buy this firm today, and we're going to get some free cash flows at time 1, and we're going to get some free cash flows from operating at time 2, and some free cash flows operating at time 3, and I'm going to go one more year, and then we're going to add in a terminal value here, which we're going to get via the Gordon growth model, and we got to make sure we have all the timeline stuff straight. But all we're doing is taking all this stuff and bringing it back here, right? So this formula, free cash flow, this is how we're going to calculate these free cash flows in each of the years, and that's all we're saying, just like we've been doing since level 1. So the big message here, okay, is don't think that this is different. You already know this, right? So it's just you're now just applying it to a target firm. Okay, now there are some interesting caveats in terms of, well, what is the discount rate and all that sort of stuff, but we're not even addressing that in this reading, so you don't need to worry about it. All right, so what about comparable company? Well, this is, again, just going to be the relative valuation. So what we need to do is say, look, if I want to know what the value of Roslovic restaurants is, then I need to understand, well, what would be the appropriate PE ratio? Well, how do you find the appropriate PE ratio? Well, maybe you can go out and find 3 other firms that are like Roslovic restaurants and say, well, here's their PEs. Let's average those together. Okay, well, I'm not sure if you're my investment banker and all you're doing is averaging, I'm going to be upset. But nonetheless, we could come up with that as a guideline to tell us what Roslovic's PE should be. Then we take the earnings of Roslovic, multiply it by the PE ratio, and there you've got a value for a minority stake. And then you say, well, I'm not buying a minority stake. I'm going to buy a control stake, right? So then you're going to increase that by whatever you think the takeover premium in that industry is. So the big point here, this is just relative valuation, okay? So, and we're doing it relative to minority prices. So in a moment, when we finish this, we'll move on to transacted prices, and then we won't have to worry about this takeover premium thing. We'll just find the PE from transacted firms, and that'll be it, right? So here's another big D&M. So this is, if you're trying to memorize your way into getting a charter, then I suppose you have to memorize this. But again, I don't think you can memorize your way into a CFA charter. You're going to have to think through this process. And all this says is, okay, what are the comparable firms? Right? So let's calculate the relative value measures for those comparable firms. And we could do that with price to earnings, price to book, price to sales, price to cash flow, just like we've been doing all along. Then we're going to get the descriptive statistics for our target firm. That is, what are their earnings, what are their sales, what's their book value, okay, what's their cash flow. And then we're going to think about what the magnitude of the takeover premium. Remember, this step 4 won't apply for an environment where we're using transacted firms. This is only if we're using minority prices. Okay? And then we're going to calculate the minority price. And if we think the takeover premium is 20%, well, we'll multiply that minority price by 1.2 to increase it by 20%. All right? Let's try a quick example. So here we have King Eateries that's going to buy Roslovic restaurants. It's like I've seen these slides before, isn't it? Anyway, so the comparable companies, what we're going to do is we're going to be given 3 of them. We're going to get the mean valuation metrics. That means we're going to have 3 companies. We're going to calculate 3 PEs. 3 PBs, 3 PSs, 3 P cash flows, okay, and we're going to find the average, and then we're going to apply those to Roslovic's, So what is Roslovic's earnings, sales, cash flows? That will give us the minority value of Roslovic, and then we'll have to deal with the takeover thing. So what we want to know is this, okay, what is the price that we should pay for Roslovic restaurants, right? Well, we don't know that. That's what we're solving for, but here are the 3 comparable firms that we have. So notice that firm 1 here is selling for $42 and it has an EPS of 3. Well, that means that it has a price to earnings ratio of 14, right? So, well, I could get a price to earnings ratio there, and I could get a price to earnings ratio for number 2 and a price to earnings ratio for number 3. Add them together, divide by 3, that would give me the mean price to earnings ratio. Then I could take this price and I could divide it by the book value per share and get a price to book. Okay, so that would be, for firm 1, do that for 2 and 3. Then I could take the price, divide it by cash flow, the price divided by sales. So I'm going to get a price to earnings, price to book, price to cash flow, price to sales ratio for each of the comparable firms. Across those comparable firms, I'm going to add them together and divide by 3 to get the mean. And then, once I've done all that, well, once I know the PE ratio, okay, I know the earnings of Roslovic, it's 205. So if we ended up getting a PE ratio of 10, right, the mean PE ratio for all these firms was 10, then I'd take 10, multiply by 2.05, and I would see that the indicated value, based on the mean PEs of the comparables, would be $20.50. And in this case, I'm going to do it 4 times and average them together, and I already told you what I think about averaging. So if I'm paying you millions of dollars as my investment banker, you better do something more than take an average, or at least make me think you're doing something more than take an average, right? Okay, now, that would give us a minority price. So if I go back, these 3 firms are minority firms, so whatever price I come up with based on that data, that's going to give me a minority price. But I'm buying a control stake, right? Control stakes are valuable. Being in control, my kids think I'm a control freak. I tell them I'm not. I'm a control enthusiast. So anyway, so if control has value, that's what I tell them, right? I'm not going to destroy my control premium. Anyway, so if I have a minority price here, I need to have an idea of what is the control premium in this industry. Well, here is 4 other companies. Right? So these are separate, and these are companies that have been transacted in the industry over some reasonable period of time. So the pre-deal price for company 1 was $27.50. The post-deal, or the deal price, was $31.50. So I'm just going to calculate the percentage change there. It's going to turn out that this is going to be about 13.7%. And then I'm going to do that for the other 4. I'm going to average it together, and that's going to be my average control premium because I'm a lazy investment banker. All right? So anyway, once I know the minority price, given the data from the last slide, and the average control premium from this slide, I'm going to take my minority price. I'm going to increase it by, 13 or 15% or whatever this comes out to be, and that is going to be my value for the target firm. All right? Okay, so step 1, we've already done that. We found our comparable companies. Step 2, we are going to calculate the relative value measures and then apply them as we go down. So here's what we got. So remember we had this, we have the share price of these 3 firms. The PE ratio for comparable firm 1 is 4. For firm 2 is 9.57. For firm 3, it's 9.44. So if I add those 3 things together, right, and divide by 3, then what I get is 11. Right? So that is the mean PE ratio for the comparable firms. And then I'm going to do the mean price to book, price to cash flow, price to sales. So I'm going to have 4 different relative valuation metrics here. So what do I do with those? I'm going to take these numbers, 11, 1.99, 8.3, and 0.93, and I'm going to take the PE, multiply it by Roslovic's E. I'm going to take the PB and multiply it by Roslovic's B. I'm going to take the P cash flow, multiply it by Roslovic's cash flow, and then sales by sales, right? So here's my mean relative valuation metrics. Here's my numbers from Roslovic. So if I take 2.05 times 11, based on the mean PE of the comparable firms, that would tell me that Roslovic is worth $22.55. Okay, I could do the same thing with PB. So my price to book ratio is 1.99. Here's my book value. Based on a price to book of the comparable firms, that would tell me Roslovic's worth $32.54, about $10 higher. Then doing the same thing with price to cash flow and price to sales, I get 4 different values for Roslovic based on these 4 different relative valuation metrics. And in the real world, we'd have to think about which one of these is, correct. But here, since it's, we're preparing for a multiple choice exam, they just tell us to take the mean. So there it is, $27.33. That is my estimated value of a minority share in Roslovic Restaurants. And if I only wanted to buy one share, that would be my price, $27.33. Now, I don't want to buy one share, right? I want to have control because I'm a control enthusiast. So I've got to estimate the takeover premium. Here is a formula you should recognize. So this is nothing but the holding period return. So this is the same as, P1 minus P0 divided by P0, right? So that's just the change in value divided by the initial value. So it's nothing but a holding period return. I'm going to do that for all four of those previous takeovers that we've seen in this industry. So the first one was 13.7. We already talked about that. Here's the other three. I average and I'm going to get 15.3%. So what do I know now, right? Well, I know the takeover premium is 15.3. I also know that the minority price is 27.33 or whatever it was I said, 27.33. I want to increase that by 15.3%. So I just multiply by 1.153, and there is my takeover price for Roslovic. All right? So that's it's easy to do. I mean, it was a lot of little calculations and numbers, and on the exam you won't be asked to do it with 4 different metrics and averaging all those together and 3 comparables and those types of things. But nonetheless, the process here, there's nothing here you don't know. There's nothing here that's difficult. It's just a matter of putting up with the boredom, much like being an investment banker. Put up with the boredom of iterating time and time again, right? So anyway, so comparable company analysis. So if this were a I'm going to go back a slide. So if we were doing this and the comparables were, instead of companies, they were transactions, then this part, okay, would have been unnecessary, right? Because that means that the takeover premium would have already been embedded in the PE ratio and the PS ratio and the PB and all that type of thing, right? So the comparable transaction is easier. You don't have to mess with an explicit calculation of the takeover premium if you're using minority prices, which would be my guess for the exam, by the way. But nonetheless, if you're using minority prices, then you do have to do the second part where you have to estimate the takeover premium and add that in when you're calculating the price per share. All right? Okay, so what about evaluating a merger bid? This is an interesting way to think of merger bids, and I think fairly valid. There's one thing in here that's really hard. Okay, fortunately for us, it's one of those things that's just too hard to have in the CFA curriculum, so we just kind of gloss over it and say what it is. So anyway, so first of all, this really is a matter of understanding the terminology or understanding the variables. So V sub AT, just remember that VAT does not stand for the value after tax, right? So what that is, it's the value of the acquirer and the target together. So what's the value of the acquirer and the target together? Well, it's going to be the value of the acquirer before the deal. It's going to be the value of the target before the deal. Then we're going to add in this S, and this is the part that's the really hard part. What are the synergies that are created? Are they, $58 million? Are they $3.2 billion? Are they 37 cents? Calculating synergies is the hard part of this. Okay, but nonetheless, that's okay because we don't have to worry about calculating them on the exam. They're just going to be given to us. And this C is, I think, important that you understand that this is the cash paid to the target shareholders. So if it's a stock deal, then the C is going to be 0. So if it's just a stock deal, what's the value of the combined firm? It's going to be the value of the acquiring firm before the deal, plus the value of the target firm before the deal, plus any synergies that we've created. So what we can do from this is then sort of parse out who's getting what. So we know the value of the acquiring firm. We know what that is. We know the value of the target firm before the deal. What we're really doing here is calculating who's getting what part of the synergies. So the gain to the target firm shareholders, that's called the transaction premium, is going to be the price that we pay, whatever that is, $22 a share maybe if it's a cash deal, minus the value of the target firm. So if we were looking at this on a per share basis and we paid, $48 and the value before the acquisition was $28, okay, well then the transaction premium here would be $20. All right? Make sense? So the gain to the target shareholders, also called the transaction premium, is just the price that we pay minus the pre-deal price of the target firm. What about the gain to the acquiring firm? Well, that's going to be the synergy minus this transaction premium that we just calculated. So what are we doing here? Well, in one case, we're calculating the transaction premium. In the second, we're calculating synergy minus the transaction premium. So in other words, when we look at the gain to A, I'm going to call it G sub A, the gain to A, plus the gain to the target firm shareholders, it's got to be equal to S. Okay, that's the value we're creating, and that says, well, that's what we have to divide up between the two groups of shareholders. So all we're doing here is saying, who's getting the S, right? So if we could buy the target firm if we could buy the target firm at its pre-deal price, that is just, what's the value, then the acquiring firm would get all of the synergies. Of course, what the target firm wants is they want some of the synergies too, right? Or all of the synergies, depending on how good of negotiators they are. So all we're doing here is dividing up who is getting the synergies. Now, what's the caveat that you need to be careful about? Okay, well, the caveat that you have to be careful about is this P, all right? So if it's a cash deal, if we say, look, we're going to pay $48 a share, then that's easy. P is $48. Okay, but remember, if it's a stock deal, you are not giving the target firm shareholders stock in the acquiring firm. Okay, so I'm acquiring, you're the target. I'm not giving you stock in my firm. I'm giving you stock in our firm, right? I'm taking you on as a partner, and that means that you're going to get stock in the combined firm, and that's not going to be equal to the value of the acquiring firm if there's any synergies and depending on a couple of other variables. So if we're talking about a stock deal, the price that we're going to pay is going to be the number of shares that we give up, okay, that's how many shares we have to distribute, times the price of the combined firm. And that's going to be, the value of the acquirer plus the value of the target plus any synergies. Okay, and then if it's an all-stock deal, there won't be any cash. So divided by the total number of shares. So what I would think of as a common mistake that people would make here is they would say, oh, well, the price of the acquiring firm is equal to, 10, and therefore I'm going to give up 100 shares times $10, so the total price I'm paying here is 1,000. Well, that's based on the acquiring firm's pre-deal price. So the price of the combined firm, that might be $11, right? So if I'm giving up 100 shares times 11, okay, well, that's going to be, what, $1,100. You think I could do that in my head? $1,100. Well, see the difference between what I paid, right? So anyway, you've got to make sure that you are allowing for the fact that the value of a share in the combined firm is not necessarily, and for the exam I would say definitely will not be, but is not necessarily equal to the value of a share in the acquiring firm before the deal, all right? So anyway, this would be the thing that I notice people get messed up on. So when we want to know the price that we pay, okay, we've got to take the number of shares that we're giving up, okay, that is that we're issuing, and then the price of the times the price of the combined firm. So just be careful with that as you prepare for the exam. All right, and there's my note that that's an important point. So anyway, so what about the effect of price and payment method? Well, so what does the acquirer want? Okay, well, the acquirer wants to pay the lowest possible price. It's just like when you go and buy a car, you're going to buy a car, you want to pay as little for it as possible, right? So maybe the floor value of that would be what is the value of the target firm before I even started talking about buying it, right? So that would be just a minority price. The target firm, what do they want? Well, it's just like if you're selling your used car, right? You want the highest possible price. So you want to get as much for it as you possibly can. And the ceiling for that is probably going to be your pre-deal price plus 100% of the synergies. So think of the floor as the value, the ceiling as the value plus the synergies. Well, what we're doing is we're dividing up who's getting those synergies, right? So anyway, that's the incentives here. Acquirer wants to pay as small as possible. Target wants as high as possible, and somehow we have to meet in the middle. Okay, what about the type of payment? Well, if it's a cash offer, well, then what happens? All right, so I'm the acquiring firm. I pay some cash to the target firm shareholders, and they go away. They're no longer part of the equation. So the acquirer is going to assume the risk and receives the potential rewards of the acquisition because the target firm shareholders are gone. So if the synergies are bigger than what anyone expected, okay, then the takeover premium for the takeover premium for the target is fixed, so the acquirer is going to win. But what if the synergies are less than was expected? So I paid the value of the share before acquisition, that was 28. I thought the synergies were going to be, whatever, $10. So I paid, what if I paid $38? That'd be 100% of the synergies. And what if synergies turned out to be 0? Okay, well, it is the acquirer that takes full responsibility of the risk and return associated with the materialization of the synergies in a cash deal. But in a stock deal, then we're not paying off those shareholders and they're not out of the equation. Now we're all one big happy family, okay, and we're going to share in the risks and rewards of the evolution of the firm, right? So if the synergies turn out to be great, okay, bigger than expected, then the target firm shareholders, they're still our partners now. They'll get some of it. We'll get some of it. Okay, and if it's less, then we're going to share in that. We'll share in the loss as well. So remember, target firm shareholders become part of the ownership structure now of the combined firm. All right, so what about what actually happens in the real world? Well, short-run effects here on stock prices are been well studied. What you see is that the average takeover premium is about 30%. Okay, so and that varies dramatically depending on what type of acquisition it is, but on average about 30%. So if you have a share of stock, it's worth $10, the firm gets acquired, well, they're probably going to pay you about $13 for that share. Okay, what happens to the acquirer? Well, the acquirer actually loses 1 to 3% of its value at the announcement of the merger. So this is the idea of the winner's curse. So there was a bidding war, right? Someone bid 48, then I bid 52, they bid 56, I said 60, I won at 60, but what happened? I overpaid, right? So we got involved in this bidding war, and we ended up overpaying. The market recognizes that, and the value of the acquiring firm goes down. This is sort of the idea of managerial hubris. We think we can make anything work and extract value when really we can't. And the long-run impact on share is that firms that do lots of acquisitions underperform. So there are clearly value-adding acquisitions in the world, okay, but firms that go on acquisition binges over a long period of time tend to underperform. And you might want to think about some of the really high flyers today and their acquisition appetite and see how that plays out over the next 10 or 15 years. I'm talking to you, Apple. Anyway, so what about downsizing to kind of round this stuff out? So we can downsize our operations through corporate restructuring. A divestiture, that just means we're going to sell, liquidate, or spin off a division. So we've got a bunch of divisions do a bunch of different things. We got one that makes suitcases. We don't like it anymore, so we spin that off, right? We could also do an equity carve-out. This is going to create a new independent company. So we're going to sell shares to outside shareholders, and that means that we're going to take our suitcase division, we're going to make a company, we're going to IPO it, and the cash is going to come into the parent company. So this is a way for the parent company to spin off a division and end up with a cash inflow, either because they've fallen on hard times and need the cash, or they have really great opportunities somewhere else, and this was the cheapest way to get the cash. We could do a spin-off. This is where we create a new independent company, okay, but we distribute the shares to the parent company shareholders. So you had one share of stock in this conglomerate. Now you have a share of stock in the conglomerate and a share of stock in the suitcase manufacturer, okay, and together they ought to be worth about the same thing, but nonetheless, there's no new shareholders and there's no new cash for the parent company. We could do a split off. This is where we're going to take our conglomerate, we're going to split off the suitcase manufacturer, and you're going to have to decide, make sure I get this right. Yeah, so you're going to have to decide which one of these firms you want to be the owner of. So some people are going to opt for suitcases, some people are going to opt for the conglomerate. It's going to be, you're going to have to exchange your shares in the conglomerate to get into the other company if that's what you want. And liquidations, this is where we're going to break up the company and sell its assets off. This is the reverse synergies. The parts are worth more than the sum of the whole. And every couple of years, it seems like we see a traded company somewhere in the U.S. that decides, hey, we're worth more in pieces than we are as a company. So they sell all the assets, pay off the bondholders, distribute big dividends, and go home, right? So, and I admire managers who are willing to face up to that. Okay, major reasons here, of course, it could be strategic. This division no longer fits within our strategy. We want to focus on core businesses. Maybe we just haven't been able to make this profitable. It's in somebody else's wheelhouse. Let's let them try for a while. This is reverse synergy thing that we just talked about, and then we just need an infusion of cash. Well, we could go in and do the equity carve-out where we're going to sell this new company, and we're going to end up with some cash for that. So that is the idea here of mergers and acquisitions. If you want to go over and think about the different types of mergers and acquisitions, I think bootstrapping, easy to write questions on bootstrapping, so I would know something about that. This Herfindahl index shows up across the 3 levels of the curriculum at several points. So something about the takeover defense and industry concentration, the impact on mergers, that type of thing. I think maybe the most important thing is this idea of, valuing the merger target. That is, comparable company, comparable transaction, DCF. Nothing new there. Just make sure that you understand what they're talking about when they talk about merger targets and DCF, or merger targets and transaction analysis, that type of thing. Evaluating a merger bid, that's kind of a cute thing where we're taking the synergies and dividing them up, and then a little bit on the concepts of divestiture and stuff down here. I think if you get a handle on that material, then I think you will have some traction when it shows up on the exam.